When things are going well, it can be tempting to lose sight of prudence. This is particularly valid when the economy is strong. During the bull market that lasted 11 years and ended in March, stocks gradually rose. Firms had simple access to financing, and many occupations offered steady compensation. Due to their assumption that they could always expect positive returns, many investors made questionable financial decisions for themselves. Warren Buffett once said, "You only find out who is swimming naked when the tide goes out." A sound investment strategy contains time-tested ideas, many of which have come to be cliched through the years. These investment facts work to keep investors out of difficulty by aiming to prevent financial blunders when times are good, in addition to ensuring that they are on pace to meet their financial goals. Given how many investors are looking for direction during these trying times, this is a great time to review these principles. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Cash is king. Having 3 to 6 months worth of expenses in cash on hand should be the first step in any prudent financial strategy. As economists and market analysts discuss the potential effects of this global coronavirus pandemic on the economy, the wealthy may be in the best position. If they lose their jobs or experience a significant decrease in income, their cash savings should let them get through these challenging times relatively unscathed. Investors who are worried about their future income would be advised to continue putting money into their emergency fund and saving aside extra cash in case the economy's recovery takes longer than expected. Number 2. Debt is bad. Many counselors will point out that borrowing money has both positive and negative aspects. They are precise. Under the right circumstances, leverage can be very helpful. However, people in the best financial situations are often those who owe no money to anyone. Even the most experienced organizations and investors run the risk of running into trouble if they don't keep a watchful eye on their debt loads. Over the next several months, there won't be a shortage of news stories about companies that fell because of their unmanageable level of debt. Eliminating debt is one of the most potent financial positions a person may be in. Number 3. A clear understanding of your time horizon is key. A person's time horizon determines how much risk they can wisely manage within their portfolio. Additionally, it keeps the difficult market conditions in perspective. The current bear market shouldn't worry you if you're a long-term investor. In actuality, it ought to give you energy. It presents a wonderful opportunity for you to buy stock at a considerable discount from its most recent trading price. If you are a short-term investor who made sensible arrangements, you shouldn't be worried by the current bear market either. Either all of your assets should have been in high-quality bonds, or your portfolio should have been cash-based. The current economic situation shouldn't have any impact on you at all, as your investments are not experiencing a dramatic fall in value. It is unwise to invest without knowing with certainty when you will need the money. Number 4. Dollar cost averaging keeps emotions in check. Dollar cost averaging is the practice of consistently adding funds to investments at regular intervals. Everyone experiences powerful emotions. Politics can incite rage in some people, whereas other professions or a company's business practices may do the same for other people. Emotional decisions should not be made in the world of successful investing. The benefit of automating frequent, automatic contributions to your investment accounts is that emotion is taken out of the decision-making process. Your ability to amass riches over time increases, and you lose interest in trying to time the market. Number 5. Rebalancing allows you to make money without much effort. To maintain the initial asset allocation specified by risk tolerance. Rebalancing is the act of altering a portfolio's weightings as investment prices rise and fall. Rebalancing is the process of selling investments whose value climbed while simultaneously raising the value of positions whose value declined. The adage, "sell high, buy cheap," is overused in the world of finance. This is a way to go about doing it. Number 6. Diversification is the only free lunch in investing. Investors have a tendency to locate the hottest investment at the time and make significant investments in it. When everything is going well, this is terrific, but all firms, sectors, industries, and countries go through cycles. When things go wrong, having an overly focused presence in one area of the market could be disastrous. The most recent examples of this were emerging market equities over the previous 10 years, banking stocks during the Great Recession, and technology stocks in the late 1990s. This has been shown historically. Diversifying across a number of asset classes is the best way to keep your portfolio from becoming highly specialized in one market segment. While using such a strategy may produce some underperformers, it may also ensure that your portfolio will also include a number of investments with quite strong returns. This meticulous approach is a clever way to weather impending market bubbles. Number 7. Markets return to the mean over time. Markets eventually return to more normal, long-term valuation levels, regardless of whether they suffer extreme optimism or pessimism. This idea holds that reversion frequently brings the market back to its prior state, returning returns and prices to their starting values. The simple lesson for individual investors is as follows: plan ahead and carry it out. Make an effort to find a balance between the importance of everything else happening around you and use your best judgment. Avoid becoming overwhelmed by the market's incessant agitation and turbulence. Number 8. Market corrections don't go sideways. Fast corrections are common in fast-moving markets, which can make it difficult for investors to make a reasonable decision about their next move. The idea is to set stops on your trades to avoid emotional reactions, and to be decisive while trading quickly altering markets. When asset prices reach a certain level, stop orders can be beneficial to traders in two different ways. They can assist investors with limiting the amount of money they lose, or assisting them in locking in a profit when prices fluctuate. In either way, by choosing a certain entry or exit point. Number 9. Conservative bonds. During bull markets, many investors won't even consider high-quality fixed income. After all, investing in anything other than rising technology stocks is unnecessary. The fact is that every investor's portfolio should include bonds. In stormy markets, they provide the psychological benefit of lowering volatility. They provide as a safety net, allowing investors to remove funds from assets without suffering a large loss in value as a result of a market drop. Finally, rebalancing opportunities exist when the value of stocks falls and the value of the highest-rated bonds rises. It is foolish to ignore bonds as a significant part of one's investment plan. Number 10. High returns mean a high level of risk. Investors frequently search for the magic solution that ensures excellent returns with no risk. When times are good and everything are going well, some people can even think they have found the solution since their assets keep increasing. However, they quickly discover that when the economy changes, enormous expected profits could also be accompanied by greater risk. Only a handful of the risk's many forms include leverage, illiquidity, and bad credit. The bottom line is that if you want to have a possibility of generating significant returns, you must be willing to accept a high amount of risk. Investors need to approach each opportunity with a clear head. Number 11. Boring over exciting could be the right approach. During bull markets, many investors won't even consider high-quality fixed income. After all, investing in anything other than rising technology stocks is unnecessary. The fact is that every investor's portfolio should include bonds. In stormy markets, they provide the psychological benefit of lowering volatility. They provide as a safety net, allowing investors to remove funds from assets without suffering a large loss in value as a result of a market drop. Finally, rebalancing opportunities exist when the value of stocks falls and the value of the highest-rated bonds rises. It is foolish to ignore bonds as a significant part of one's investment plan. Number 12. Once you win the game, stop playing. Particularly if you've amassed a sizable sum of money over the course of your trading career, the stock market could become addictive. Realizing that investing's primary objective is to assist a person in achieving their financial goals is crucial. Once the investor reaches that magical sum, there is no need to keep putting that money at risk. Of course, if there are long-term objectives that will take several generations to complete, the capital should be invested wisely. However, an investor may move out of equities any money that has already been saved to sustain their lifestyle. The fortunate situation for investors who have reached that point is that they are no longer concerned about the impending bear market. However, a significant market decline does have one advantage: it forces investors to reflect on the decisions they made during the bull market. As they ponder, they are forced to ask themselves if they have followed these tried and true investing guidelines. If they've veered off course, it might be devastating and bankrupting. But if they stick to the principles, they should have a better chance of long-term success. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.